Let's break it down. For years, the simple story went like this. Stocks are risky, bonds are safe. Stocks go up and down, bonds are steady and protect you. But in this market, that old picture is breaking. Both stocks and bonds can hit you in ways many small investors don't expect. I'm Imran, a Middle East-based analyst who follows markets, policy, and global economics. In about 3 minutes, let's walk through what risk really means today for stocks and bonds, and what a normal investor should take from it. If you like clear, simple breakdowns like this, please hit subscribe so you don't miss the next one. First, what do people usually mean by risk? Most people think risk are price swings. Stocks, big swings, sometimes crashes. High risk, bonds, smaller moves, regular interest payments, low risk. That's not completely wrong, but it's only one layer. Risk also includes inflation risk, your money losing buying power. Interest rate risk, bond prices falling when rates rise. Concentration risk, too much of your money in one type of asset, sector or country. So yes, stocks can fall 20-30% in a bad year. But long-term bonds can also lose double-digit percentages when interest rates jump, and safe cash can be quietly eaten by inflation if it sits too long with no return. Second, what has changed in this market? On the stock side, we've had a long run where big tech and AI-related names have pulled the indexes higher. A lot of investors end up heavily exposed to the same handful of giant companies through index funds, sector ETFs, and even thematic funds. That means when those leaders fall together, diversified portfolios can suddenly look much less diversified. The line between broad market exposure and betting on a few megacaps is thinner than it looks. On the bond side, the last few years reminded people that bond prices can fall hard when yields rise. Anyone who bought long-term government or corporate bonds when yields were near zero has learned that lesson the hard way. A bond that looked safe on day one can still show you painful losses on your statement. At the same time, short-term bonds and cash-like products now pay more interest than they did for most of the past decade. So, the risk picture has flipped. Bonds are no longer a simple set-and-forget safety net. Cash is no longer guaranteed dead money, but it can still lag inflation. Quick pause here. If this kind of breakdown helps you think more clearly about your money and the news, please like the video and make sure you're subscribed. It really helps the channel grow and tells me to keep making more videos like this. Third, what can a normal investor do with this? A few practical ideas. Don't assume stocks, long-term danger, bonds, long-term safe. Ask, what specific risk am I taking here? Price swings, inflation, interest rates, concentration. Look inside your funds. Are you really diversified, or are you just holding the same big names in different wrappers? Think in time horizons. Money you truly don't need for 10+ years can usually handle more stock market risk. Money you need in the next 1 to 3 years shouldn't depend on stock prices being kind. Understand that no risk does not exist. Even sitting in cash is a bet. A bet that you're okay with inflation slowly eroding your buying power. So let's break it down one last time. The old story, stocks wild, bonds safe, is too simple for the world we're in now. Stocks can be extremely concentrated and over-dependent on a few winners. Bonds can fall sharply when rates move. Cash can quietly lose value to inflation. Real risk is not just about volatility on a chart, it's about how likely you are to reach your goals without being forced to sell at the worst possible time. This is Imran Breaks It Down. If you found this helpful, please subscribe, like the video, and tell me your thoughts in the comments. Do you still see bonds as the safe part of your portfolio, or are you rethinking what safety means? Share this with a friend who's trying to figure out their investments, and if you're already subscribed, thank you. We'll keep breaking it down together.